And when you look at what's happened the last 24 hours or so, what you're seeing is all the predictable things. You're seeing gold rally, you're seeing the equity market perform better, and it all makes sense because if you're a global allocator of capital, what the Fed just told you is that the return to cash is going to be lower for the next several quarters. And what that means as an asset allocator is that you're going to tend to move towards risk assets and hold even less in cash. So this is a short-term rally. I think it's all been driven by what the Fed did in the last 24 hours.
Maybe. I think Greece gets a lot more attention than it really should, given the size of the economy, the influence. There's the discussion of contagion. Clearly, it gets a lot more influence. It gets a lot more discussion relative to the U.S. economy. I would argue the impact on the U.S. economy is not that dramatic. The signs, whether it's housing starts or auto sales or humans being hired, is pretty impressive. The data you can count, as opposed to GDP, which we think is skewed, and aggregate retail sales, is pretty impressive.
Within that time frame, Simon, I don't think there's a lot to fear for Fitbit. It's a clear leader in the market, obviously, with more than 11 million units sold last year. So doing very well out of the gates. And like I said, the good news is, and as you've mentioned on the program previously, Apple is not in this market with comparable performance in terms of either price points or integrated GPS or battery life. So there's a lot of room for Fitbit to maneuver within the next couple of years. Beyond that, though, a lot of challenges in competing with the iOS ecosystem and Internet of Things power that Apple can bring to bear.